We see continued weakness in the S&P 500 as earnings week continues, pretty much red nearly right across the board, and today our focus is going to be on Coca Cola. Now, they reported yesterday before the market opened, and for those that don't know, one of the best investors, Warren Buffett, does hold this quite significantly, as we would say around 9% of his total position, and one that he has held on for many years. Now, how did the company do? Well, as we will come to show you, they did have a double beat. However, they were down around 2%, and right now this company is pulling back from the 52-week high, trading right now in the mid to upper end of the 52-week range. So is this Dividend King one we should consider in our overall portfolio and essentially buy the dip? Now, how have they performed? Well, first things first, they've had to increase their prices as ultimately the demand, therefore the volume that they have sold of their products, has started to come down. Now, in terms of the actual numbers, what we in fact can see here, earnings per share, nice beat, 77 versus 74 anticipated. And again, in terms of the top line, a nice 350 million beat. We do have to point out though that for this quarter, the bottom line was lower, in fact 66 cents per share, and as we can see, same quarter last year, 71 cents. On top of that, the actual net sales that we see of 11.95 billion is pretty much flat from the same year. Now remember why we don't like to see this, because inflation continues to increase year on year, average at 4%. So if they aren't at least increasing by that total, in effect, real terms, it is decreasing. Now, as we've mentioned, their unit sales, so in terms of the number of products that people are buying, did drop around 1%, and we can see one of the main contributors of this is what they call weakening demand specifically to their international market. What they've also noticed is something that we've seen right across earnings, in fact, over the last few weeks, that consumers are starting to weaken. We're getting in an environment where now consumers are deciding to either buy less of their favorite products or move away from certain brands like Coca Cola, like Pepsi, and buy, for example, supermarket brands. And they also talk about here that consumers are buying smaller sized drinks at their favorite fast food restaurants. One thing though that they are very proud of is that they are continuing to beat their rival, that they would say PepsiCo, and that is a very positive sign for this company. Now, whether or not that is something you want to take into consideration, it is something that they mention, and as we have just mentioned, it isn't just Coca-Cola, but other companies like PepsiCo are starting to see volume decline by around 3%, and they particularly attribute this to weaker demand for energy drinks. So overall, it is good news. They have done a double beat, but the overarching message here is that consumers are starting to be a bit more wary of what they are buying, how much they are buying, and moving away from certain branded goods to the own store goods, and in fact just buying less in terms of quantity. Now, going back to this company, as we said, it is down 2% just yesterday after what we would say are semi-decent earnings. As we can see, over the last 12 months, up 26%. Over the last 10 years, it is up 62%. Now, this doesn't include dividends reinvested, so you would be up slightly higher, but as we will come to show you later on in the episode, it has underperformed the S&P during this time. As we can see, mid to upper end of 52-week range, one buy rating just from Wall Street, both Seeking Alpha and Quant give this a hold. In terms of the dividend yield, well, 2.8% forward looking. In terms of forward P, around 24, so marginally lower than the S&P, which right now is trading at a forward P of 25. So in terms of moving forwards, they are still expecting growth every single quarter on a year-on-year basis, but we can see this isn't a company that is going to increase double digits, so do have realistic expectations. What is nice to note though, over the previous 4 quarters, at a bare minimum, they have been in line with management target, so a nice 100% track record. As we can see, EPS is anticipated to grow over the next full year, lowering that forward P to 22.84. Now, in terms of the metrics, safe dividend score, which is great to note, at 80. In terms of dividend yield theory, we're going to take a look here, as well as the forward P. We also do note that they did increase the dividend this year at 5.4%, which is marginally above that 4% we target, just to keep up in line with inflation. Now, reaffirm their dividend safety score this August. Essentially, for Coca-Cola, dividend cut does look unlikely. Now, how do they perform in the last recession? Always good to know some of these key metrics. Well, they increased the dividend during the 07-09 crash. They had above average growth, -5%, S&P -12 during that time, and they outperformed the S&P, still -31, but the S&P itself returning negative 55. In terms of dividend growth, well, as we mentioned, marginally above inflation this year, marginally below over the last 5 years, over the last 20 years, increasing it at 7% on a year-on-year basis. We've already mentioned they are a dividend king, and you get that status with 50 plus years of consecutive increases that we can see they've done, but they've also been paying a dividend for the last 104 years without a reduction. Now, based on this model, in terms of undervaluation or overvaluation, we can see for the large part of the last 12 months, Coca Cola has been trading within the blue intrinsic value bucket, but we notice right now it is trading towards the upper end. Remember though, we will run this through our own valuation model towards the end. We then get to dividend yield theory. Now this says a company is undervalued when the current yield sits above the 5-year average. So you could argue here reasonable valuation, possible slight overvaluation, and on the forward PE we get a similar conclusion here. The current PE on a forward-looking basis isn't far off the 5-year, therefore concluding reasonable valuation. We do, however, note the consumer staples sector PE at 18.6 does sit lower. Now do remember, we're not looking at any one of these models in isolation, and we will conclude towards the end of the episode. Free cash flow payout, as always, over earnings, which is susceptible to manipulation by management through accounting. Below 70% is what we want. Now we've seen historically it is very, very high, 80% over the last 2 years. Over the next 12 months, around 76%, which is pretty much why we would say with this company, don't expect too much in terms of dividend increases, probably around the 4 to 6% on a year-on-year basis. At a minimum though, we do expect it to keep up in line with inflation. We then move on to the free cash flow, where we want consistent increases over the longer term, but what we get here in fact is very inconsistent. Yes, it has increased from 2014 to 2023, but lots of up and down on a year-on-year basis. Nice to report though, over the next 12 months a marginal increase is anticipated to $2.54 per share. Then we get to their sales growth. Now remember, 3% or 4% just keep up in line with inflation. We notice 6 of the last 10 years have been negative. Last 3 years have been fairly positive, but do remember this company, in order to increase their top line, they are finding they are now having to essentially increase their prices of their products to compensate for the volume which is starting to lower. Now, how long can they essentially increase prices before consumers totally turn away? That is something that maybe we will find out, and possibly could hurt them in the long run if the consumer environment doesn't start to change. From a numerical basis, as we can see here, 46 billion in 2014, 46 the essential same in 2023. Shares outstanding, we want to find out, do companies return excess cash through share buybacks, giving you a larger portion of control of the company? Not massively, yes, a little bit, trivial, very little in fact, and also not on a consistent basis, so not something we would include in the overall investment thesis. ROIC looking good, above 12% that we want to see for consumer staples, very consistent. We do get increases over the longer term, which is nice to note, and remember we want that minimum 10% just to ensure management are effectively allocating their capital. Operating margin, we get operating efficiency here, which we love to see. 24% in 2014, 29% in 2023, and above that bare minimum, so that is off to a good sign in terms of the operating aspect. Free cash flow margin also looking very strong and very healthy. Maybe not consistent, but still looking very good in terms of the numbers. Last few years in the 20% range. We then get to the final metric, net debt to EBITDA, earnings before the interest, tax, depreciation, amortization. Below 4 is what we want. Below 4 is what we get every single year. From the highs of 2020, it has started to come down. 2.08 in 2023. Remember, number of years to take essentially the company to pay off all of its debt net of cash on hand. 1.73, so even lower over the next 12 months. And why we focus on this metric, remember, correlate dividend safety, balance sheet strength, and based on this information, there aren't any real issues that we want to flag for this aspect. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox. We talk about undervalued stocks that we believe deserve your attention, as well as running through what's happened in the market over the last few days. So do click on the pinned comment below, sign up, and you can start reading straight away. You will also be able to gain access to 36 undervalued stocks for the month of October. We run through a lot of information, talk about the upside that Wall Street themselves see over the next 12 months, and flag those that sit within our own portfolio for those that are interested. And you can also grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside out of the whole S&P 500. So as we said, click below, sign up, and you can read straight away. Moving on to insider ownership, well, just under 1%, around 631 million worth of sales by these insiders over the last year. In terms of the more recent quarter, no movement. Q3 around 580 million, and as we can see, it isn't in fact a surprise to see insiders sell, as this is something they continually do on a quarter by quarter basis. Now, for those that want to know the exact details, well, the more recent sale, you could argue a little bit outdated now. 27th of August, 18,000 shares, netting her $1.3 million. Remember, information is there, but this isn't what we would consider to be bearish at all. Insiders sell many reasons, personal and financial. Now, institutional aspects, 70%, around 7.5 million worth of sales over the last year. We get around 11 billion worth of buys during the same time period. And we do want to point out that Q3, pretty much the first time since Q3 of the last year, that institutions have sold, although a little bit more than they have bought. Overall though, as we can see, over the last 12 months, institutions have been buying more. And remember, never copy institution trades or insiders, and do your own due diligence. Now, we've already flagged their revenue has been very inconsistent, very topsy-turvy. In fact, the same revenue reported in 2014 as 2023. But really, we want to highlight here the bottom line. Have we seen improvement in the profitability? And the answer is yes and no. There is a lot of inconsistency here on the bottom line. It has increased, but not as much as maybe we'd want to see. 7 billion in 2014, 10.7 in 2023. Again, the information is just here, so you can come up with your own investment thesis, but ideally we want to see top line revenue increase consistently, as well as this bottom line net income, neither of which we have seen today. Then we move on to the health of the company, total cash versus total debt. We notice their cash has been decreasing over the last 10 years, in fact going from 22 billion in 2014 to 18 billion. Nonetheless, still a very healthy amount, although in isolation, these numbers are not going to tell us anything, which is why we compare that 18 billion cash numerically and directionally to their total debt, which is very interesting. It has barely moved over the last 10 years, fairly stagnant from around 42 billion in 2014 to 46 in the latest quarter. But as we saw, the net debt to EBITDA is coming lower and lower on a year-on-year basis. So overall, no massive issues with the health of this company. Then we get into some gradings. Now they get a D-. As we already mentioned, they are trading at a premium to the sector. Coca Cola around 24, sector median around 18. So right now, if you are clicking on that buy button, you are paying a 35% premium to the overall sector, but that is pretty much shown through whichever metric you use. And remember, some companies do truly deserve a premium. Is Coca Cola one of those? That is something you need to consider. In terms of growth, well, they get a D. Revenue year on year, 3%, not far off, in fact, the sector median of 2.2. Forward looking around 4, again, not far off the sector at 3%. And moving forwards, the earnings per share is expected to grow by around 6%, the sector around 7.1. So right now, based on the growth, it doesn't deserve to trade at a premium. And that is where we get to profitability, where it does look very, very good. We get an A+. Now, gross profit margin, 60%, sector median, 36%, bottom line, 22%, much, much better than the overall sector at 4.2. And talking about much, much better, cash from operations, 5.5 billion versus the overall sector average of 760 million. So yes, it does trade at a premium. Growth isn't that great, but profitability does truly shine with Coca Cola. Now, a quick recap of this part of the analysis: a buy from Wall Street, a double hold from Seeking Alpha and Quant, D- on valuation, D on growth, with an A+ on profitability. Now, before we jump into the valuation, let's compare their performance against others in the sector. We have PepsiCo, Monster, Keurig, Dr. Pepper, as well as other well-known others. Now, over the last 12 months, total return, including dividends reinvested, one of the best performing, up 30%. When we look over the last 5 years, 45%, not a great return over a 5-year period, and pretty much around the middle of their competitors. Over the last 10 years, it is up 123% towards the lower end, and again, not really great, as we are going to come to show you, it has underperformed the S&P. Now look, over the last year, you might say a very, very close 37 versus 30. However, when we do look at it over the last 5 years, and more importantly, when we zoom out, S&P has outperformed. Now, do you think this is maybe a great price to buy today that will be able to outperform? Or if not, remember, low-cost ETFs, there are many, many to consider if you believe that is the far safer bet for the future. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $68, we got that by running it through 3 models. The first one, the multiples valuation, companies in a similar sector and size. Average PE, we get that multiplied by the EPS of Coke, and we pretty much get, whilst it says an undervaluation signal, it isn't that far off, so we would call this reasonable valuation. Just remember though, we don't look at any one of these models in isolation. Then get the dividend discount model. Now average growth 4%, the more recent one at 5.5%. We've gone for 5% moving forwards, and we get here again very similar to the previous model, an overvaluation, but again we would call this pretty much a reasonable valuation. We then get to the DCF model, free cash flow year on year, average growth 4%, analyst targeting 10% moving forwards. With the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and again, pretty much all 3 models today showing us a reasonable valuation, which is why the intrinsic value, which is the average of these 3, comes to 68. Remember, you can click on the pinned comment below to grab a copy of this model, run your own numbers through, whether it's for Coca Cola or any others that you do desire. Now, as always, on this channel, we do like to do a margin of safety at 10%, and we'd execute on that if it hits the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, well, a 10% MOS would be a buy at $61. But what in effect we are saying, we believe right now, if you are buying this company, you are essentially buying it at its intrinsic value. You're not paying a premium. You're also not getting a discount. For those that do want to know though, at 10%, as we just saw, $61 price target, at 15% around 58, at 20% around 54, and at 25% around $51. As we said though, essentially no premium, no margin of safety, trading at its fair value. Although Wall Street don't agree, they see upside over the next 12 months at $76 price target, giving this 11%. As always though, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all in the next one.